All right. How's everybody doing tonight?
Good.
Since there's one. Okay. So we're having a little bit of technical difficulty on this end, but we're gonna get started, and hopefully Jack can dive in when he gets going here. So if you have questions as we go along, as those of you who know, well, first of all, let me introduce myself for those of you who don't know. My name's Jack Kiley. I'm a principal at MidAtlantic IRA, and we also have a tax practice as well, John Kiley CPA. And at the end of the year, we always do a tax update, and this will go a little bit beyond just retirement plans. So there will be some highlights with respect to individual tax and business tax, as well as retirement plans. And I'm just going to hit highlights. So we're not there. There was a lot of things in the tax law that was passed. I'm not going to get into everything, but just the highlights are the things that affect most of our clients. And I'll give you a good example. There's a lot of things, for instance, on EV cars and those sorts of things, and generally, what we've come to find is that the car producers will tell you if you qualify for if their cars qualify for the credit, because the onus is really on them with respect to content and all those sorts of things. So, we're not gonna delve too deeply into some of these topics. So I've got this broken out into effectively four areas. One is some individual tax highlights, business tax highlights, some estate and wealth building highlights, retirement plans, obviously, and then we'll kind of pull it all together. So because I can't necessarily see everybody that's on the call, if you have a question, put your just put your hand up and put it in the chat, and we'll either address it at the time, or we'll address it as I come to it. So if you could help me out a little bit there, I'd appreciate it. Um, so again, my name's Jack Kiley. I'm a CPA. I've been involved in retirement plans and tax work forever, a long time, I think, suffice it to say. This is over the years. There's been big changes to tax law, little changes. I would say one of the biggest things that occurred this year is that Congress has this penchant for putting things in place that are temporary in nature, and then 5 years, 6 years, 8 years out, it reverts back. And one of the things that this bill did was it made a lot of the deductions and a lot of the things that were advantageous to taxpayers and to businesses permanent. So really, what that means in the tax world is that Congress actually has to go and pass a bill that would repeal those things, and I'll mention a number of them as we move along. So I'm going to start with some personal tax items, and the first thing that the bill did is it made permanent uh, the seven tax brackets that have been in place for a number of years, and it made permanent the two lower tax brackets, which were the 10 and 12%. So our system is what's called a progressive system. So you run through each one of the tax rates as if your income is, for instance, 150,000, part of that is at 10%, parts at 12, on up the line. And on the high end, it capped the high end rate at 37%, which is still a lot of money. But it was scheduled to be 39.6. So it was going to revert to the brackets that were in place back in 2016. So again, all of that, the current tax structure, tax rate structure is permanent. The good news is the two lower rates stay in place, and the high rate is capped at 37%, and when it was scheduled to go to 39.6. Okay. The next item, which gets a lot of buzz in my area, and for those of you who I live in the DC area, I think I'm looking at people on the call. A lot of the names I know are in the DC metro area. And specifically, if you're in a high rent state like Maryland, the district, Virginia's getting there. The SALT deduction, or state and local income tax, was capped at $10,000. And that's been that ever since that was put in place. That's been a subject of debate, and I think that's being kind. That has temporarily been increased to $40,000. So in states like Maryland, which not only have a high income tax rate, but they have a high real estate tax and a middle of the road sales tax rate, typically people will use their withholding, their income tax, their state tax, plus the real estate, and they're well above $10,000. So people who live in those high tax states, and in this area again, that's primarily Maryland district and parts of Virginia, depending on where you live, your real estate taxes are increasing. You're going to get the benefit of the of being up and above that $10,000, or that old $10,000 cap, which is now $40,000. And that is scheduled to, and this is what Congress always does, that's scheduled to phase out in 2029. So starting in 2030, then we're back to the $10,000 cap. Okay. For one of the other things that came into play is there's a new deduction for seniors. So if you're in the over 65 club and you do not itemize your deductions, excuse me, there's an additional $6,000 standard deduction. So if you're married, I think that puts your standard deduction up somewhere in the mid 30s, 33, 34, 35,000. And if you're single, it takes you to right around, I'm going to say in the high 20s, maybe even 30,000. So this was designed to counteract the fact that Social Security, if you're above certain income thresholds, which really isn't hard to get to, then up to 80% of your Social Security is taxed. So not only did you have the pleasure of paying into the system when as you were working, but you also get to pay tax on what you get to pull out of the system, as you collect. So anyway, that $6,000 additional deduction is designed to help to offset a bit of that. All right. One item that got a lot of buzz was the deduction for overtime and for tipped employees. So I think at least for my clients, it's going to be probably a little bit of a red herring, because overtime, if you're a salaried employee, you're not necessarily paying. Oh, did you get them? Thanks. All right. So if you're a salaried employee, sometimes overtime is not really part of your pay package. So so that's got to be sorted out with your employer. And tipped employees, basically what that means is that you have to declare all your tips, which I'm sure you do, with your employer. So that this has been sort of an ongoing debate for years, and to sort of to go back literally probably 10, 15 years. When I was a much younger and I was a waiter, we never claimed tips, right? I mean, you just put them in your pocket and life went on. at some point, probably back in the it was either late '80s, early '90s, the government said that the employer had to track tips, and if you didn't have tips or you didn't declare them to the employer, they had what they called deemed tips, and depending on what your salary was, where you worked, and all these, there was a fairly complicated computation to figure out what that deemed number was. And really, what the government was after is two things. They're after, obviously, income tax, but they were also after you paying into Social Security and Medicare. Okay. So if for those of you, if there's anybody on the call that's a tipped employee, you actually have a couple of other line items on your W-2 that are completed, which talk about the amount of pay that is tips and the amount that is salary. So up to $25,000 can be deducted of tips and overtime, so long as your income is under $150,000. So as it gets above that 150 threshold, then you start to lose benefits. So and there's a long list of which vocations are subject or this deduction is available to. So you've got to check that list out. And if you want it, I'm more than happy to send it to you. I'm not gonna go through it right now, but there's some vocations where, although you get tips or you may get tips, they're not going to you're not going to get a deduction for them. So that was obviously the overtime and the tip deduction was much ballyhooed, but I don't, at least for my clientele, I don't know that it's going to make that big. It's going to move the needle very much. Tax credits increase of child tax credit increases from $200 to $2,200 per child, so you get a little bump there. The other change is with respect to deductions is charitable. So there's a 0.5% floor on charitable deductions. And essentially what that means is that it's going to be treated the same way medical expenses are. So currently, if you itemize your deductions and you have medical expenses, your medical expenses have to be above 7.5% of your adjusted gross income. So if your adjusted gross income is $100,000, just so I can do the numbers in my head, you have to have more than $7,500 of medical to deduct anything. So if you had $8,000 of medical expenses, only $500 would be deductible to you as an itemized deduction. So with contributions, it's a 0.5% floor. So if you had that $100,000, the first $500 you don't get credit for, and anything above that. And in my experience, what you're going to see is over time, that floor is probably going to go up, okay? Because when the government gives you a deduction for something, that means they're not collecting revenue on that. So, that's something that's new. That's currently, we don't have a floor on contributions. Whatever you contribute, you can just deduct. Also, if you are a non-itemized deduction person, so if you use the standard deduction, you can deduct up to another $1,000 in contributions. So there's a little bit of a benefit there. Other items of note, I think on the individual side, that pretty much takes care of the highlights. And I'm gonna open this up for a minute here or two. Anybody and anything that seemed unclear or needs to be we need to go into a little deeper on the individual side. Anybody have any questions on that? No? Okay. Going once, going twice. All right. So let's talk about some changes on the business side. Okay. The biggest one is that the law made permanent what's called a 199A deduction. So for those of you who are self-employed or you have an S corp or you have a business, okay, it doesn't mean you have to be a sole proprietor, but basically you got a deduction, a 20% deduction from net earnings, from net income of that business. And interestingly enough, this was also true if you have rental property. So if you have three or four rental properties, they qualify as a as a business, or at least for this deduction, they qualify as a business, even though their rental income is by definition is a passive activity. So so there's this helps a lot of our clients in that they're small business owners. They get to deduct 20%, and they own rental property, and they can deduct another 20% of whatever the net rental income is there. So the whole idea when this was passed back in 2016 was this brought parity to in with C corporations and small businesses, which for the most part are taxed at the individual income tax rates. So back in the day, the corporate rate, the high corporate rate was roughly I think it was 30%. Individuals were up to 39-ish%. And that 20% difference is where this deduction comes from. Okay. So, and it's a little complicated, but it's anyway, it's a help. Okay. So anyway, it made that permanent. It was scheduled to expire at the end of this year, and Congress decided to make it permanent. The other two big changes is it also made permanent expensing of equipment and one time taking depreciation in the first year for most types of property, not real property, but I'm going to get a little wonky here. What's called 1245 property and certain qualified other property. So you can think of 1245 property as anything that's movable. So computers, desks, furniture, fixtures, appliances, those sorts of things. And where that really comes in handy from a tax planning standpoint is if you've got to put out as a business, if I've got to spend $20,000, $30,000, $40,000 for equipment, and I'm only getting a portion of that deductible in year one, year two, year three, year four, my cash flows are different from my taxable income. Okay, so now it sort of evens that up a little bit, and in most cases, it makes it exactly the same. So it's easier to plan, is the thing. Okay, there's something called a 179 election, which allows you to expense property over and above that in year one. It it increased the limits to that. The law increased the limits to that. And you do a little bit of a balancing act between the expensing of equipment and the first year depreciation, what's called bonus depreciation. And the nuance there is that bonus depreciation can take you to a net loss, whereas 179 election will only get you to zero. So as you're looking at your return, you want to kind of balance those two things off. They also in this law was a change to what are called opportunity zones. So back in 2016, you could defer. There was a technique for deferring capital gains into new ventures, new businesses, new real estate, those sorts of things, if you invested it in an opportunity zone. And typically opportunity zones were maybe not the the best places that you want to be, but under the new law, it enhanced, it expanded those incentives and those areas for business and similar investments. So you want to, if you're looking to open a new business or buy property somewhere, it'd be good to look and see if it's in an opportunity zone, because it might save you a little bit more money. The other big business change that comes up is for those of you who have benefits attached to your business, you might want to consider, especially if you have kids or you've got employees that are paying back student loans. There's a program that you can put in place. It's a benefit for your employees, which effectively makes payments on those student loans tax free, quite frankly. So for those of you who are familiar with health insurance plans, there's something called a Section 125 plan, whereas there's money that's paid out of employees' pay to for their portion of health insurance, and they basically don't pay tax on that. And it's the same, conceptually, it's the same sort of plan. So those are, and that's permanent. That was, and I know personally, we looked at this as a business last year, and we decided not to do it because it was only for 1 year, and the issue was, why go through all that for 1 year? So that becomes permanent. And those are the big business changes. There's, again, there's a bunch of other things. I don't think a lot of it applies to us. But any questions on the business side? Any comments, thoughts?
You can also put your questions in the chat if you don't have a working microphone or you don't want to turn on your microphone.
Hi, this is Joyce Kiley. I do have a question.
Mm-hmm.
For the opportunity zones, did you say that was a permanent thing, or that's still temporary, but they just increased some of the benefit of doing that?
Well, I think they definitely expanded. They expanded the opportunity zones, and I think they changed some of the time frames on those. But I don't know that it's, it was temporary in the sense that you had to hold property for a certain period of time. But once you got past that, it was the capital gains, effectively was mitigated or was free. But I don't see, it's still temporary as far as I can tell.
Okay.
Okay.
Yep.
Okay.
Jack,
anybody else?
The 199A that's for a 20% deduction. Is that 199? Is that a form or is that a pamphlet or?
It's a category.
It's there is a form for it, but essentially the 199A is if you have net income from a business or what's referred to as a business activity. So again, we have a lot of clients that own real estate. They're rental properties.
Right.
And rental property or rents is, at least in the tax world, is not a business activity unless you're a real estate professional. If you're a real estate professional, you're sort of in a different bucket. Okay. But for somebody that might own 1, 2, 5 rental properties, they're just, and they have a day job, let's say, it's just an investment activity. Okay, so it's not subject to Social Security and Medicare, unlike a business where you pay income tax and somebody pays tax, either an employee or the business owner himself pays self-employment tax. So my point to this is there's other activities other than purely business activities that can take that 199 deduction. It's really based on a couple of different factors. So when you boil it all out, it works out to be somewhere around 20% of the net income from the venture. But it takes into account net income, property that's used in the business, and also wages. So there's sort of three components. And when you work through the calculation, you come up to effectively about a 20% deduction. Okay. So if you have a loss, you're not going to get a deduction, obviously. Does that make sense?
Yes, thanks. Yeah, I have properties, and I just never heard of that. But before, with depreciation stuff, a lot of times you end up with a loss. But I'm way past that now.
Yeah. So if you have rental property, you have to make an election to take the 199 deduction. Okay.
Okay.
So and if you have a tax preparer, I would, if the person is any good at all, they're taking that deduction. Okay. If they're not, fire them. Okay.
Okay.
So anybody else? Oh, okay. So with respect to estates, probably the biggest change and the most important change is the law made permanent the current estate exemption at $15 million a person. It's scheduled to go back down to 7, which still sounds like a hell of a lot of money, but they made permanent at 15 million a person, and also they made permanent what's called portability. So one of the things that we used to run through in before portability was that each person had a certain amount of money that was exempt. Okay, and I'm going to step back for those of you who are unfamiliar or only tangentially know what an estate tax is. An estate tax is really, over the course of your lifetime, you have the opportunity to pass on or give away things and stuff up to a certain limit. And over the course of years, it's been as low as $1 million on the federal level, and it's been as high as 15 million. Okay. And the reason it's so high now really has to do with the fact that there's a lot of farmers that live in the Midwest who have big farms, and those things are that the land is very valuable, maybe not necessarily for farming, but for other purposes. And when they're evaluated for estate purposes, it's for the best use. It's not necessarily the use that it is now. So what you had is a lot of family farms in particular who were trying to, mom, dad passed away, and they want to pass the farm on to the children, and the value was such that they couldn't pay the tax. Okay, so that was the starting of ratcheting this thing up, and of course, it only helps the rest of us. Portability, back in those days, you weren't able to, if you didn't use your exemption amount, you could not pass that on to anybody. It died with you. So what portability did is said, if you had husband and wife and husband passes away, whatever he didn't use in his exemption, he could give, if you will, to his spouse. Okay. So that had the effect basically of really supercharging this exemption. Now, in the beginning of this conversation, I said you have, over your lifetime, you have the opportunity to give away these things and stuff. Okay. There's also something called a gift tax. Okay. So one of the things that a lot of our more wealth-minded clients are looking at is effectively shifting those assets or that they have from one generation to another, and not necessarily waiting to death. Okay, so the reality is most of us, although I would like to be there, most of us are not going to reach the $15 million threshold. Okay, or if you're married, $30 million. Okay, so you can create entities or trusts or even through a gifting program, a current gifting program, and move or shift some of those assets from you personally to either a trust or your children or something controlled by your children or something along those lines. But there's a lot of creativity that goes on in moving these assets from one generation to another from a wealth standpoint and effectively keeping the vast majority of what you have. Now, although we get to breathe a little bit because the federal limit is high, each state has an estate threshold as well, and some states have an inheritance tax. So that's where this gifting while you're alive comes into play, because you can, if you do it ratably over time, you can avoid on the state level. And the other thing you need to think about too is, at least where I live, we have a lot of small states squished together. So if I own property, I'll use me as an example. I own property in Maryland. I also own property in New Jersey. If something happens to me, then there's an estate issue both in Maryland and New Jersey. Okay, so you want to think about this a little holistically. Don't go to sleep on this because the federal estate limits are high. Okay, your states are still significantly lower than that, and I think Maryland is like 5 million is my recollection, and I could be wrong on that. So don't quote me on that, but that's a third of what the federal limit is. So you want to look at what's going on at the state level as well as the Fed level as you're looking at these things. Okay. So those are the two big things. So it made permanent the $15 million per person exemption, and also that portability component. Any questions there?
Jack,
Okay.
is it per person inheritance? Is that like my wife would be 15 and I'd be 15, or is it the person receiving it?
No, it's the person giving. Okay, so you have the opportunity over your lifetime and in death to give away up to, or currently on the federal level, give away up to $15 million of things and stuff, and keep me in your thoughts. Okay, so but the state level is going to be different. Okay, so just recognize that. Okay. And the other reason I bring this up too, one of the things that we've run into a couple of times is that, if you are making a gift to somebody, so I'll give you an example that we ran into a little bit ago. A parent was giving a child I forget what it was. It was a depreciable asset of some sort, or I'm sorry, an appreciating asset of some sort. It was a piece of real estate. Okay. And it was not in our area, it wasn't very highly valued, but it was, still I say that glibly, it's $150,000. And it was really the reason the parents were giving it to this child is because the child was not very, had a hard time keeping a job, wasn't as well off as the other two children, those sorts of things. And we all know people who have, families and where that's an issue. Okay. if you just give property to somebody, okay, the basis of that, and you do not file a gift tax return, okay, the basis in the person who you gave it to. So in my client's case, the child's basis in that property is the same as the parents when they bought it. Okay, so and they've had that property for about 30 years. So, they said that they bought the property for $30,000 and it's now worth $150,000. Okay. So if that child goes and sells the property, they're going to recognize a capital gain of $120,000 if mom and dad if dad, whoever owns the property, doesn't file a gift tax return. Because the basis is the basis at purchase. Okay. If they file a gift tax return, then they're not going to have to pay any money because it just reduces that $15 million amount that you can give away. Okay. So, big deal. Now mom and dad can only give away $14,850,000 as opposed to $15 million, right? But the child's basis in that property is now $150,000 as opposed to $30,000. Okay. So when you're looking at gifting property, okay, money isn't so much an issue because obviously a dollar's worth a dollar. Okay. But if you're looking at giving away or gifting appreciated property, you're going to want to file a gift tax return. Okay. Even though you're not going to have to pay, there's no money due. It's just an accounting and keeping track of how much of that 15 million you still have left to give away, but you want to make sure that you do that. Any questions there? People understand what I'm driving at?
So Jack, just on the example there at the end, I was trying to take notes, and so so if you do it under a gift tax return, then the basis is going to be at 150K. Is that right? If they go to sell it,
that's correct.
Okay.
That's correct. Yeah. If the giftor, right, the person making the gift, does not file a gift tax return, then the basis of the property, whatever is given away, is whatever the purchase price or the acquisition, cost was when they bought it. So, that's particularly with appreciated properties like real estate. And you'll see this, technically gems are the same way. So if you gave away, a necklace that happened to have significant value to it, you got the same problem.
Okay, thank you.
Yep, you bet. Anybody else?
So Jack, in that instance, let's say that you gave the property away and it was at the original value. Is that 3 to 5 rule apply still? If you lived in it, they lived in it for 3 to 5 for the gain?
Oh, you're talking about for exemption, the 250? Yes.
Yeah.
So they're at the point of gift, right?
Right.
Now they're deemed effectively title transfers, right? Because you're going to retitle the property. So that's the point that now you own the property and you have to live in property that you owned for 2 of the last 5 years to get that exemption.
Okay, thanks.
Yep. Anybody else? We kicked this one around enough? Okay. Let's talk about retirement plans for a minute. So literally last Friday, the new contribution limits came out for a bunch of different plans. So starting in 2026, if you're involved in a 401k plan, the deferral element, and that's the part that comes out of your pay, is going to increase to $24,500. So it goes up $1,000 from $23,500 to $24,500. And if you're lucky enough to be in the over 50 club, there's another $7,500 catch up. Okay. The overall threshold for plans increases from 70,000 in 2025 to 72,000 in 2026. Right. So that's those are going to be the new contribution limits for 401k plans. If you have a simple plan, it's going from, the deferral is going from 17 to from 16 to 17, and the catch up is still at 3,500. If you have an IRA limits are going from 7,000 to 7,500 in 26, and then the catch up is moving from $1,000 to $1,100. So this is the first time that I can remember that it's not either $1,000 or $500 increment increase. So this is going to be a little bit different. And also, in I guess a couple of years ago, there's a special catch up if you are either 60, if you're 60 through 63. So those 4 years, you're either 60, 61, 62, 63. That catch up is $11,250. Okay. I don't know why it's just for those ages, but there's a special catch up if you're lucky enough or unlucky enough to be 60 to 63. So if you're younger than that, too bad. If you're older than that, that's too bad too. Okay. The other thing that comes into play for starting in 2026. So there were 2 laws that were passed a while back. One was called Secure Act 1 and one was called Secure Act 2. And these 2 statutes dealt exclusively with retirement plans. And one item that is coming into play starting in 2026 that wasn't currently, or most, well, I'm going to say all, because I'm unaware of any custodians that put this in place prior to this. But you are going to be able to make Roth contributions into SEP plans up to the contribution limit. So starting in 2026, you could make your SEP contribution as a Roth SEP, not a pre-tax or a deductible SEP. Okay. And the same with simple plans. So simple, if you had a simple plan, that deferral element, that $17,000 deferral had to be tax deductible. It could not be Roth. So they're changing that. All custodians have to make that change starting January of 2026. So we had clients that, for instance, they would go through this routine where they would, for a SEP, they'd make a SEP contribution to a SEP plan, and then they'd have to convert it to Roth. So there was, we were always playing this little bit of a shell game. So we don't have to do that anymore. The other change beginning in 2026 is that if you have a required employer contribution, so you can think of this as the match, okay, then the employee has the opportunity to have that treated as Roth or pre-tax. Currently, it's pre-tax, okay? But you're going to have the ability to do that on a Roth basis. Now, if you do that on a Roth basis, what's going to happen is that's going to be taxable to you. Okay, so it's going to show up, and I haven't seen the W-2 forms, but I suspect it'll be in probably box 12 of the W-2, where it'll be added to your income. Okay, so there's a fair number of new provisions on old plans which are basically what they're going to do is they're going to add Roth components to all the plans. So the major plan types currently, you have IRAs. There's always been IRAs, and since probably about 95, 96, there's been Roth IRAs. Okay. 401k plans, SEPs, and SIMPLEs. Those are the four major plan types. And now all those plans will have Roth components, whereas up to this year, it was only IRAs where you had Roth IRAs and 401k plans where you could make a Roth if the custodian allowed it, okay, or the administrator allowed it, you could make that deferral as a Roth on a Roth basis as opposed to a pre-tax basis. So it's going to bring all those plans into parity with respect to Roth components. Okay. Any questions on that or thoughts? Okay. So usually one of the other thing that plans you're going to see in a lot of plans starting in 26 is the ability to convert pre-tax to Roth within the plan. Okay. So, one of the questions that usually comes up is gee, why is the government allowing us to do this? And really the reason for this more than anything else is that pre-tax contributions are deductible to somebody. Okay, somebody's getting a tax deduction for it. And the contract here is that if you get a tax deduction for it now, at some point in the future, when you pull the money out, you're going to pay tax on whatever it is that you pull out. So because the government is in such dire straits, if they don't give you a tax deduction for it now, then you're paying tax, right? So to them, that's a win because they would much rather have your money now than have it later. Okay, so that's the reason that you're seeing all these Roth things. Now, if you're like me, you're getting deluged with convert to Roth, Roth conversion strategies, blah 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 blah. So is this a good thing or a bad thing? And you really, the answer to that is like most things in tax is maybe it's good, maybe it's bad. And a lot of that depends on your personal situation. Now, one of the things that at least this is my personal opinion. This is sort of Jack's rule. Okay. I always make my contributions on a deductible basis. Okay. And the reason for that is because the tax deduction is worth more to me now than the tax-free treatment later. Okay. Secondarily, and most of you who are clients of MidAtlantic, okay, can certainly appreciate this. With alternative investments particularly, there is always an opportunity to convert somewhere down the line. And to the extent that all these plans are now allowing in-plan conversions, this becomes particularly attractive. So, so if you've got, your investments, the value of investments goes up and down and up and down, right? So as they hit a low point, okay, maybe that's the time to convert. And I'll give you, and some of you who have been on these calls, and in fact, I know one or two people who have actually utilized this strategy. With alternative investments, there's because they're illiquid to begin with, many times there's already built-in discounting. So if I have an interest in a partnership Well, let's say for the sake of discussion that that Joyce and Doug and I pool our money together. We form a small LLC and we buy a piece of property. And we each put in, just to keep it simple, we each put in $33-ish thousand. We got $100,000 of capital and we buy a piece of property for $100,000. Okay. And I use retirement plan money. Okay. And we buy that property is 100,000. Okay. So although my investment in the entity is 33,333, and the property, my part of the property is 33,333, my ownership, the fair market value of my ownership interest in that entity is not going to be $33,000. Okay, because there's two issues here. First of all, I don't have control of the entity. Okay. So if somebody is to buy my interest in the entity, they've got to run through Joyce and Doug to get anything done. Okay. Secondarily, they don't even know Joyce and Doug. Right. So you've got this issue of what's called lack of control, and generally speaking, LLCs, particularly small LLCs, are not marketable. Okay, so there's discounting probably on two fronts. So I would go out and I'd get that thing appraised, and it might come back at most of the discounting that we see is somewhere in the 25 to 40% range. So let's just strike the difference, in the middle. Let's say it's a third. Okay. So the value of that might come back at 20 grand. So if I convert it 20 grand, I'll pay tax on $20,000. Okay. But when the property sells, and even if it sells for the same 100,000 and I get my 33 back, okay, there's a permanent timing difference there in my example of 13,000. Does that make sense to everybody? So by taking my deduction up front and then picking and choosing my time of conversion, I might be able to have some permanent tax timing differences and save money. That makes sense? I'll give you another example, and this one's personal. So, and some of you, I know Larry's heard this before, and probably John's heard this before, and Bob, but it's one of my favorite stories, so I'm going to tell it again because it's one of my wins, right? So, I made a loan to a friend of mine, $50,000 out of my IRA. Okay. After I made that loan, probably 2-3 months later, he lost his job. And he called me up and he said, Jack, I'm not going to be able to pay back the loan on the payment schedule that we have because I lost my job and blah, blah, blah. And I said, don't worry about it. Okay, you get back. And I wasn't particularly worried because I had a security interest in a piece of property. Okay. So, I said to him, don't worry about it. Get back on your feet. We'll reschedule the loan and we'll move forward. So 1 month turned into 2 turned into 3. Now it's 90 days past due. Okay. So what I did is I called him up and I said, hey, John, I'm not going to foreclose. Okay. But I'm going to send you a notice of foreclosure because the loan is so far in arrears. And he wasn't happy about it, but he understood it. And I did that. And I actually did it through a lawyer. Okay. And the reason I did that more than anything else is because now I have a loan that's in default. And I went out and I got that loan appraised, that $50,000 loan. Okay. And the value of that came back at $28,000. Okay. That's the fair market value. And when you convert, you pay tax on the fair market value of whatever the assets are that you converted. Okay. So I converted, value at 28 grand. Okay. Good news is the story had a happy ending. He's got a job. We rescheduled the payments, paid me back in full. So $50,000 plus interest went into my Roth, and I only paid tax on 28 grand on the conversion. So I had a permanent timing difference on principal of 22,000. Okay. And of course the interest went into the Roth. But that's an opportunity. That's a place where you see something goes a little sideways. And if you know what your assets are, okay, and you invest wisely, sometimes these bad turns, there's an opportunity there for you. Okay. So anyway, conversions, you should think about converting on your time frame as opposed to just putting the money in up front, because for most of you, if you're in your high earning years, the deduction is worth more to you now than the tax savings years from now. Okay. So the other question that usually arises with all this buzz about Roth is, why bother to begin with? I mean, I got to pay the tax. I got to pay the tax. Whether I pay it now, I pay it later, who the hell cares? And, there's a certain level of truth to that. But if you are thinking holistically of your wealth, okay, in retirement, first of all, the likelihood that you're going to retire, particularly if you're self-employed, the likelihood that you're going to retire at 65, 67, whatever your anointed retirement age is, if you're self-employed, is probably not likely. And especially if you're in real estate. So if you think about this, if you're in real estate and somebody comes to you and they say, John, list my property for me, are you going to sit there and say, I can't do that. I'm 68 years old. I'm retired. No, you're going to list the property. It's like money that fell into your pocket, right? You might not work as hard as you work now, but the idea that you're going to fully retire and go play golf or fish or hunt or read books or whatever it is that you like to do in your spare time is not very likely. In 40 years of tax practice, and my practice is comprised of people who are in the top 10%, and most of them are in the top 5% of wage earners in the country. Okay. I can count on one hand the number of people that actually retired. And to me, that's astounding, because over the years, I've literally had thousands of clients. Okay. So full retirement is, I don't want to say it's a myth, but let's just say it's maybe a story that's been told by companies that want your money. Okay. All right. But the likelihood is that you're not going to go to zero. You're not going to work as hard as you work now, but you're going to work on your terms. To me, retirement means that you work on your terms as opposed to work on somebody else's terms. Okay. So if that's the case, having some money in Roth and being able to pick and choose and regulate your income is helpful. So in years where you have higher earnings, maybe you take distributions out of Roth. Lower years, you take it out of pre-tax money. Secondarily, when you turn 72 currently, okay, you have to take required minimum distributions out of the traditional accounts, not out of Roth accounts, only out of traditional accounts. So those are traditional IRAs, pre-tax 401ks, and the like. Okay. So, depending on what your income levels are, you have to take into account, those minimum distributions. And for a lot of people, they don't need them. They don't necessarily need the money at 72, 73, 74. They would much rather leave it in as long as they can leave it in because, you know, most of us will utilize our funds not in the early years of retirement, but in the later years. So I'm going to sort of weaving topics together here, but a lot of financial planners will talk to you about what's called the 4% rule, which basically says that in retirement, you should spend 4% of whatever the value, that's what you're budgeting, 4% of whatever the accumulated value of those accounts are. And really, that's a number that was developed years ago, and people, stock gurus looked at the markets, and they said that was the number that should be paid out. And where that number really comes from, at least in my opinion, is that's the average dividend and return on a bond historically is 4%. So if you have $1 million portfolio, 4% is 40 grand. Okay, two problems with that. First of all, most people who enter retirement have the same amount of debt that they had when they were 50. So if you have the same amount of debt at 50, how are you going to spend less money to service the same amount of debt? Probably not going to happen. Okay. So that argues for continuing to work longer. Okay. So, and as you move money from traditional, you convert to Roth, you're not adding or you're not compounding more money that you have to take out taxable on top of taxable funds already. So you can keep your adjusted gross income low. Because the other thing that comes into play for those of you who are collecting Social Security now is every year there's a calculation that's made as to what you pay into Medicare. And actually, I misstated that. Anybody who's on Medicare right now, which is anybody that's 65 or older, each year they do what's called an IRMA calculation. Basically, they look at what your income is, and there's some add backs to that. Okay. And this is paying into Medicare or paying your Medicare premium is really a socialist system. You pay according to your means. So if your income is above certain levels, you're paying more than somebody who is below those levels. Okay, so it has nothing to do with your general health or your age or anything else. It's pure and simple. It deals with how much money you have. Okay, how much money you're taxed on. Okay, so another reason to regulate those. And lastly, about a year ago, they changed the inherited IRA rules. So you used to have something called a stretch IRA, and this was a big strategy where if the owner of the retirement account passed away and they left it if you leave it to your spouse, the spouse can treat it as their own. If you leave it to somebody else, it used to be where they would take minimum distributions. They'd have to take minimum distributions over their life expectancy. So if you had somebody that inherited an IRA that was in their 20s, that thing had a long stretch period, probably 50, 60, 70 years. Okay. And I'll give you an example of this. My father-in-law years ago put I have a daughter who's special needs, and he put her as the beneficiary for his retirement account. And at the time it was like, I don't know, somewhere around $200,000. Okay. And she at the time was 19. And I ran a calculation, and even if it only earned 5%, that $200,000 over her life expectancy would have paid her out over $2.5 million. Okay, staggering. Okay, in 2020, Congress changed the rules on inherited IRAs and basically said that from the time that you die, that IRA has to be drained by the end of the 11th year after your death. So it's really, when you read the rules, it's going to say 10 years. But that 10 years starts the year after your death. Okay. So, and it has to be drained at the end of that 10 years. Okay. So if you have a traditional IRA, whoever inherits that thing is going to be taxed on the distributions that come out. Okay. So you can look at it one of two ways. Gee, it's found money. They got to pay tax on it. Too bad. They're living on my gratitude, right? Because I left them that money. Okay. If it's Roth, there's no tax. It still has to be paid out in 10 years, but there's no tax on the distributions because it's Roth. So that's one reason that you're seeing all these ads and these things about converting to Roth, because it's more of an estate planning issue as opposed to a current tax issue. That makes sense. Okay. Secondarily, under the new rules, if the person at the time who died, the beneficial owner of the account was collected or was paying out, they were in what's called RMD status, then those RMDs had to continue for the next 10 years at that higher level. Okay. So another reason to go to Roth, because if you convert to Roth, there are no RMDs. Okay. So I know I threw a lot out there. Any questions, comments, thoughts, anything unclear? I'm sure there had to be something that was unclear about that. Nobody?
Yeah, can I state it back to you and see if I got it?
Sure. Yeah, fair enough.
So inheritance from an IRA. So if an IRA gets passed to you or passed to an heir, the heir will have to take out an RMD over, I think, 13 years, I think you said, and they'll have to pay tax on any of that coming out. Is that right? When they take because it's never been taxed.
Right. So in the beneficiary's hands, so beneficiaries, let's talk about this for a second. First of all, when you name a beneficiary on your retirement account, let's just talk about IRAs, and it's the same with all retirement plans, okay? It doesn't matter what your will says, okay? It's who you named as the beneficiary on the retirement plan document. So about once every couple of years, we run into a situation where a client opened an account, and at the time they were married to spouse number one. Okay. Between that time and the time that they died, they got divorced and they remarried spouse number two. Okay. In their will, it says the account goes to spouse number two, but because they never changed it with us, it's spouse number one. Okay. Because that's what's on the documents. Okay. So now is the time that you really want to look at the documents, is really where I was going with that. Okay. So you want to review your beneficiaries. Okay. So beneficiaries come in three forms. The spouse can treat the IRA as their own. Okay. So it's basically the money moves to an account for them, and it's as if it was always theirs. So there's no 10-year rule. There's no minimum distributions. There's no nothing. Okay. Unless they're of RMD stage. Okay. That's number one. The second is if they leave it to an entity, so think like a charity. Okay. The charity has to pay it out in 5 years, not 10 years. Okay. And generally charities are exempt, so there's no tax to pay. The middle ground is individuals who are not the spouse. So, and there's certain other exceptions. So disabled people can treat it the same way a spouse can, and there's one or two other exceptions. But by and large, everybody else has that 10-year rule. So first thing you're doing is you're looking at the age of the person that died. If they're of required minimum distribution status, which basically means they were over 72 at the time of death, then that RMD schedule continues based on the age of the decedent, not the age of the recipient. Okay? So if the person that died, and again, I'm going to use my father-in-law as an example, he passed away earlier this year at 95 years old. Okay, my wife and her two sisters inherited that retirement account. Those payouts are significantly large because his RMDs were large because he was so old. So they're going to that account will be empty well before the 10 years runs. Okay. If there's any money left in the account at the end of 10 years, it must be drained at that point. Okay. So, there's a lot of people sitting out there on large retirement account balances because we've been trained and conditioned to put money in retirement plans. So think of your 401k plans. You put money in for 30 plus years. It's a boatload of money in there. Okay. So how in your wealth strategy or your wealth plan, your financial plan, how do you keep as much of that in your family, and how do you mitigate any tax problems that may be caused by that for your children or whoever you're leaving it to? Okay. So that's where this becomes important. And again, if it's Roth money, although the 10-year rule is still in place, meaning it's got to be drained at the end of 10 years, but there's no tax because it's all after tax money. Okay. And there's no minimum distributions. So in my, sort of in my planning mind, if I die, one of the things that I hope I've drilled into my kids after an appropriate mourning period, okay, don't take any, let that thing run the 10 years because it'll accumulate tax deferred, right? Or tax free, I mean. Why pull that money out before the 10 years is run? Because it's just going to compound at whatever the true interest or the true return on investment rate is, as opposed to taking it out and paying tax on the return on investment every year. Okay. So anybody else? Any other questions?
Jack, I just got a clarification question, and it's not a correction, but isn't the new RMD 73?
It's, I'm sorry. You're right. It is 73. And it is.
Me. You scared me.
No. I'm sorry. Joyce is looking at it. I know she was looking at it. She's thinking, it's not 72. So,
and it's only 73 for a short period before it goes to 75. So depending on the age. Well,
that's right. So if you're, yep. So the good news is for those of us who are going to reach 70, we're not going to reach 73 by 2033, as if there aren't enough threes out there. In 2033, that RMD age moves from 73 to 75. So if you are 73 before 2033, then even though it's moved to 75, you're still going to have to take those RMDs. But if you're not of RMD status in 2033, okay, then it's going to jump to 75. Does that make sense? Kind of, sort of.
Mm-hmm.
Okay.
And Jack, that RMD can be adjusted every year depending on how much you leave in there. In other words, right. if you start with X number of dollars, but you take out more than what the RMD is, your next RMD would probably be lower if you didn't.
Okay, so two things there. So the short answer is yes, you're right. Okay, so a couple of things. Let's talk about RMD for calculation. The calculation of the RMD is based on your age and the fair market value of the assets in the account as of December 31st of the prior year. So if we're talking about an RMD for 2025, okay, it's based on the fair market value of the account as of December 31st of 2024. Okay? And whatever that number is the minimum amount that you have to take out. Now, one thing I get asked a lot, there is no carryover. So if your minimum distribution amount was $10,000, if you take out $15,000, you can't take the extra $5,000 and reduce next year's RMD. Okay. Each year is discrete, stands on its own. If you take out more, you take out more. Okay. Secondarily, if you have accounts at multiple institutions, which is common, so maybe you have an account with us at MidAtlantic, maybe you have an account at Vanguard, maybe you have an account at Fidelity. Okay. You can aggregate all those accounts. Each one of those institutions will tell you what the minimum distribution is that you need to take out based on the assets at their institution. So if at MidAtlantic it came back and you had to take out $5,000 and you have money at Fidelity and it's $2,000 and you have money at Vanguard and it's another $5,000, you've got a total minimum distribution of $12,000 in my example. Okay, you can take the $12,000 from any of those, or you can split it up however you want. It doesn't have to be pro rata. Okay,
except 401ks.
401ks are different because your 401k is plan specific.
Okay.
Yep. But yes, IRAs are, and the difference there is that generally speaking, the IRA rules are universal. Whether your account is with us or with Fidelity, the rules are the same. Contribution limits are the same. RMDs are the same. The only thing that might be different is your options for investments. So obviously, MidAtlantic, you can invest in anything permissible by law. Fidelity says it's only stocks, bonds, whatever they make a market in. Okay, 401k plans. Each plan has its own set of rules, which is why those RMDs are based on that plan. Many plans. Now, this is not solo 401ks, but many plans, employer or what are called ERISA plans, if you're still working for that company, you're not there in their plan provision may be that you don't have to take an RMD based on age. Okay, so you want to look at the plan. You want to look at your summary plan description, and then you want to look at the adoption agreement. Okay. Anybody else? All right. I'm going to leave you lastly, we're almost at the end here. I'm going to leave you with something to supercharge your accounts. Okay. So this is primarily for people who are self-employed. You have a solo 401k plan. Okay. There is a way to effectively get more money into those retirement accounts, okay, over and above the contribution, the calculated limits. And I'm going to step back and I'm going to talk about something that I call my bucket theory. Okay, so money to me, from a tax standpoint, falls into three buckets. There's a taxable, tax deferred, and tax free bucket. Taxable is everything we do. Okay. So you work, all of that's taxable. You buy property and you sell it, it's taxable. You have interest and dividends are taxable. Okay. So everything that you do is in that taxable bucket. Tax deferred, there's a couple of things that fall into tax deferred. Obviously, we've talked about retirement plans. So traditional IRAs, pre-tax plans. Annuities are tax deferred vehicles, right? Okay. And then lastly, tax-free. Tax-free is Roth, municipal bonds, although with municipal bonds, the rate is already baked in because they take into account that you're not paying federal or state tax on it. Okay. And lastly is life insurance, although most of us really don't care about life insurance because we're debt. That's somebody else's gift, right? So you've got these three buckets. So the question becomes, how do you move money from bucket to bucket to bucket? And in a perfect world, if you had everything in either tax deferred or tax free, right? As you get older, you'd move from paying tax on production, in other words, everything you earn, to being taxed on consumption, which is only what you spend. Okay, so if you think about this, if I own a piece of real estate that I bought at $50,000 and I sell it for $150,000 and it's taxable, okay, I pay tax on $100,000, the difference between 50 and 150. If I spend 25,000, I still pay tax on $100,000 because that was the gain at sale. Okay. If I do that in my IRA, I don't pay tax, right? It's all deferred. And if it's Roth, it's free. But if I have that same thing, I bought a piece of property for 50, I sold it for 150 in my retirement account, I have a gain of $100,000. It just goes back into the retirement account. You know, for those of you who are unfamiliar with self-direction, think of it this way. If I bought Google stock for $100 and I sold it for $10,000 in my retirement account, what happens to the capital gain? Nothing. The money just goes back into the account, right?
Yeah.
Same thing with real estate. The money just goes back in the account. Okay. So again, what happens is the more money that you can put in the tax deferred or the tax free, you move from being taxed on production, okay, to being taxed on consumption. And theoretically, there should be a gap between those two numbers, right? Because if you're spending more than you earn, then you got another problem. Okay. So as you get into retirement age, and I don't mean retirement, once you get over 59 and a half, you have the ability to access these other buckets, tax deferred and tax free, without penalty as you need them, right? So even more if we can push it over there. So if you hold that as the backdrop, for those of you who are self-employed, and particularly if you're using a solo 401k plan, you have the opportunity to put money in there, regardless of your earnings, okay, up to the maximum limit, so which currently is $70,000. Okay, so you can, and it's called a mega. You'll hear the term mega Roth, and that's what we're talking about here. So if I had, basically, there's three components of the calculation. There's the deferral element, okay, which comes out of your pay. There's the employer contribution, and then anything over that has to be put into the account. If you're going to do it, has to be put into the account as what's called Roth designated money, okay, meaning that it's still taxable to you, but it's basically Roth money. Okay, so let me run through an example. Let's say that I have an S corporation, okay, and it's a small S corporation, and I've got W-2. I take out of that, I take $50,000 in salary, which leaves me with $25,000 of net income, business income. So my total earnings is $75,000, okay, of which I've taken part of that out in salary, 50 grand, and the other 25 is just net earnings, net income. So the first thing I would do is I make my deferral contribution. I take it out of my pay of $23,500, and I'm using 2025 numbers here. Okay, so I defer 23.5 out of my wages. Okay, my employer contribution would be 25% of my wage. So 25% of 50 is another 12.5. Okay, so 12.5 plus the 23.5 is 36. so far. Everybody with me there? Okay. All right. So I could make a contribution of another $34,000, and that's the difference between 70 and 36, into the account as that mega Roth, okay, or is that what's called Roth designated money? Okay. So I'm not going to get a deduction for it, but basically what happens is everything that it earns from here on out is tax-free. Okay. All right. If I'm in the over 50 club, okay, which looking at some people on the call, I would say they're in my club, right? I'm barely over 50. Okay. I'd still make that 23.5 deferral. I also have a catch up of 7,500. Okay. I still have the employer contribution, which is 12.5, and the sum total of all of those is 43.5. So that's the 23.5, the 7,500, and the 12.5 sums up to 43.5. Okay. If I subtract 43.5 from 70, then I can put 26.5 in as that mega Roth contribution. And that's a way to move money over and above your calculated contribution limits from that taxable bucket to the tax deferred or tax free in this case. Okay. Any thoughts, comments about that?
Yeah, Jack, it's Bob.
Hey,
where
Bob.
are you getting this other money from to put in there?
Where do you have it? You can get it from anywhere you want. Okay.
So if it's from your savings or other stocks or something like that, then you could put that in.
I mean right. I mean the mechanism is you would put it in your, well, it's your it's an elective deferral. Okay. So it's technically, it's not company, it's not company money. It's money that you as an individual participant are electing to put into the plan. Okay. So the first gate to this is that this works best if you have so if you have a small business and you do not have any other employees, okay, it's just you. Or, if you really wanted to think about this and you want to supercharge it, maybe you employ your spouse if you're married. Okay. Right. So, but basically, if you have, for instance, if you're involved in what's called an ERISA plan, meaning that you have employees, that employer contribution, you have to maximize it. Okay. So if I'm maximizing it for me and I've got employees, I've got to maximize for them as well. Okay. Then I can still go over and above that to do my mega Roth, but it's going to be more expensive because I've got to, in order to do that, I've got to put in for everybody else. So just by way of example, I'll see if I can do this in my head. If I make $100,000, okay, and I have an employee that makes 50, right? So solo 401k plans are for owners only. Okay, so this, in my case, what I'm talking about is somebody who's not an owner. Okay, so if I make 100 and my employee makes 50, my employer contribution is going to be 25% of my salary. So 25,000, that's 25% of 100. And for my employee, it's 25% of 50, which is 12.5. So in order for me to go over and above to the mega Roth, I've got to put in 12.5 for somebody else. That's why it doesn't work well with when you have employees. Okay, unless you're, you don't have any, you're more than happy to do that. Okay, but does that make sense to everybody?
Yep. I did have a question though, Jack.
Sure.
In terms of when we do these, say, mega Roth contributions, does that start a new 5-year clock each time you do that? Or is the fact that you initially had that Roth where the clock starts?
Well, it's so technically it's in the plan. Okay, it's not your Roth. It's in the business plan. Okay.
Yeah.
All right. So the 5-year, the short answer to your question is yes. Okay, it's each time you make a contribution, or you technically it's not Roth money yet. Okay, you have to convert it to Roth when you pull it out of the plan, when you roll it over to a Roth. Okay, so that 5-year rule is when you put it in that big chunk in the plan. Now that said, Roth money is. Are you familiar with what are called the ordering rules?
Not so much on that part of it, no.
Okay. All right. So in retirement plans, there's something called the ordering rules. So with IRAs, you could have contributions that were fully deductible, and then you have non-deductible contributions. Okay, so when you put money in a traditional IRA, if your income was above certain limits and you were involved in 401k plans, you may not have gotten a full deduction for everything that you put in there. Okay.
Okay.
When you pull the money out of a traditional IRA, there's a percentage that's developed. So it's the non-deductible percentage versus the total IRA. So if over the course of years I had $100,000 in my retirement account and $10,000 was non-deductible, every dollar I pull out, 90 cents is taxed, and the other 10 is just coming back to me because I already paid tax on it.
Okay, gotcha.
Follow? Yep. Okay.
Yep, follow that.
In Roth, the first money out are contributions and conversions. Okay, so earnings is last. So if I converted today, if I converted $50,000 today, okay, and a year from now, so now the account, I converted 50 grand and now the account is worth $60,000. I made $10,000 in a year. Okay. So long as I pull out less than 50,000 bucks, I'm not going to pay tax because the first money out is what I put in on conversions. Okay. So although the 5-year runs, the point to this is that although that 5-year clock, you're right, runs, that's only on the earnings. Okay. So for a lot of people, the vast majority of what they put in. So if you've been, diligent and you put money in year and year and year and year. Okay. So maybe you've got, your account, let's say it doubles, right? So you put in $200,000 of contributions and you do really well and it doubles. Okay. If you pull out, even though you're under 5 years, if you pull out less than 200,000, you're not going to pay tax. Okay. All right. So, yes, the 5-year runs, but from a practical standpoint, you're probably not going to pull out unless you're in really dire straits. You're probably not going to pull out the earnings, or you're not going to pull out money that gets you to the earnings. And even if you do, you're only going to pay, if you're over 59 and a half, you're only paying income tax. So it's treated like traditional IRA money. So it's not as if you're penalized or any of those sorts of things.
Right.
Okay. So any other questions, comments? Thoughts about anything that we've talked about? Because I know we covered a bunch of different stuff. And
I have a couple questions about this Mega Roth.
sure.
So is this available for 2025 tax year or just 2026?
Yep. So what you're looking at, one of the things that you have to look at is, does your plan allow contribution, non-deductible deferrals is I think what they'll call it. Okay. So you got to look at your solo plan document.
Okay.
Okay.
And if you are going to make that contribution, is it a contribution you can make up until a certain date in 2026? Okay.
So you file the point that you file your tax return.
Okay.
So 401k plan, including extensions. Okay. Because for most people, you're not even, if you think of it from a practical standpoint, you're not even going to really know what that, what the employer contribution is and all those things until you calculate, especially people who are LLCs. Not so much with S corporations, but if you're just a sole proprietor or an LLC,
And what was the exact term you said to look for in the plan?
I think you're going to see a lot of different terms, but really it's going to be something that is like excess deferrals or non-deductible deferrals, and it's over and above Roth. So, when you look at the plan document, it'll say that you can make deferrals from your pay. And it'll say that you can either make them as traditional, pre-tax is really the term they'll use, or Roth. And then somewhere a little further down, it'll say, the plan allows excess deferrals, or they're not going to use the term Roth because Roth means something else. Okay. So, and if you want, just send me the plan document. I'll look at it. I'm more than happy to do it for all you guys. Okay. So, but that's it. This is a, particularly for people who are self-employed, this is a way to really beef up those plans. And, if you're self-employed and you're married, and again, the focus is to put more money into these plans, you might really want to consider somehow involving your spouse or including your spouse in your business. So, if you're like me, my spouse really does more work in my business than I do. So she, in my case, she deserves to get paid more. So, all right. Anything else? Anybody else? Anything that we've talked about tonight? Because we're pretty much.
Just a quick question that may not have a good answer, but so as I look at this and I think of my time in retirement that I would have, hopefully, and how do you hedge? Or so all these things are complicated. You're figuring out your minimum distributions. Maybe I want to convert to a Roth IRA because I don't want to have to take out it and have all these balance. And then all of a sudden they blow up the tax laws. Like they could always, any point could change the RMD calculations. They could probably, hopefully won't happen, but they could say, you know what, Roth IRAs are taxable to some extent, or if you convert, maybe now they're going to be taxable later. So we could do all this meticulous planning, but if I'm looking at 20, 25 years from now, who knows? Just how do you get comfortable with that and stuff?
Well, I think there's a couple of things that come into play. First off, in tax, nothing happens very quickly. Okay. So usually what happens is a congressman or a congressperson floats an idea. Okay. So sort of wet their finger and they put it up in the air, and they sort of take the temperature of what that is, how that flies, so to speak. Okay. The other thing that you have to keep in mind, so things don't change very quickly. So my point is that you're probably going to have a fair amount of runway before there's a change. Okay. Secondarily, there are a lot of very well-heeled people, i.e., big contributors to both parties, who have I almost said something very bad, a boatload of money in retirement plans. Okay. So they are not going to, go for that it's not going to go down very well. Okay. So I'll give you a good example. Okay. There are, some of you may remember, and this goes back about 10 years, where they talked about taxing excess amounts in retirement plans. So at the time, they were saying if your retirement plan was worth more than $1 million, there was going to be a surtax of, I can't remember the percentage, okay, on those excess earnings. Okay. A lot of people blew a gasket over that, because think about, the average retirement account in the US has about $50,000, which sounds like a really low threshold. Okay. But there are many, many IRAs and retirement plans that have, literally millions and tens of millions of dollars. So think like ESOP plans, employee stock ownership plans. Okay. Think about defined benefit plans, which are plans which money gets in a lot faster. There were a couple of, remember back in when, who's old enough to remember Romney running for president? Okay. At that time, and the rest of you are lying who didn't raise your hands. Okay. At the time, they talked about him having a $300 million Roth IRA. Okay. And he's not the only guy out there that has that. So those big contributors are not going to allow those things to go down very easily. Even, I mean, if you look at what's happened in the estate tax arena, one of the reasons, I talked about farmers. Okay. The other reason that limit is so high is because those big contributors own businesses and they own big companies. They don't own, Jack Kiley's tax practice. They own really, really significant sized businesses, and they would take, an enormous hit on those things. And those people vote with their pocketbook. I'm sure there's a number of people, I'm going to sound really jaded here. I'm sure there's a number of people that make political contributions because they believe in the cause, right? There are infinitely more people that contribute to both parties because they hedge their bets and they want a seat at the table, and we're talking about a level that's way above us. Okay. But make no mistake, that happens. So I don't think it's very likely that they're going to change that. And I'll give you another example. From time to time, you hear about them, and you'll hear about it soon, coming up in around 2030, because the Social Security system is going to go broke for at least the third time in my working life. And I'm sure they'll come up with a fix that will be the last, a permanent fix, which it never is, because it's a Ponzi scheme, right? Okay. But the point of that is, what you hear each time is that they talk about taking retirement plans and folding them into the Social Security system. Okay. My personal opinion is that that'll never happen because of these guys, that have copious amounts of money in these plans. And quite frankly, if it did, if it was me, I'd cash all my money in. I'd be more than happy to have half of my money than give it all to the government and hope that I get some of it back. I mean, I can lose my money much better than they can lose my money. Okay, so but if you think about a lot of these things that you've heard over the years, especially the ones that you kind of go, oh my God, that would really be painful. The reason they go away is because those high dollar contributors. Okay.
Jack, I just got a quick question. I just want to make sure I got it clear in my mind. The gift tax deduction that we talked about, return, that's if I have 3 children, I can give each one 15 million, or the total to all 3 can only be?
Your total is 15 million.
My total.
How you cut that, right, your total, because it's your money. They're your assets. Okay. How you cut that up is up to you. Okay. And again, don't forget any of the rest of us on this call. Okay. We're all.
So, but the other factor would be, if I'm married, does my wife get 15 and I get 15, or just both of us 15?
Yes. No. You have 15, she has 15, which is where titling of assets becomes important.
Okay.
So if you're so for instance, most states on the East, so Maryland is what's called a joint tenancy state. Okay. So if I own property with my wife, I believe that I can basically cut that up any way that I want. I could say that she owns 70% of it and I own 30%. If it's unstated, then it's 50-50. Out west, or in what are called community property states, everything is, every asset is split between spouses based on some percentage of ownership that has to be spelled out in the document. So for instance, if I own real estate, it says I own an undivided interest of X and my wife owns an undivided interest of Y. Okay. So, so you got to look at what kind of, are you a community property state or a joint tenancy state?
Okay, thanks. Yeah, it's been pretty useful. Some of this information, 1 or 2 things are really pretty important. There are thousands of dollars here that could have been left on the table. Thanks.
Yeah. No, you're welcome. So, anybody else? Any other questions? Okay. So I appreciate your time. I hope you guys got some value out of this. I'm sure there's some things to think about, and you got to take it back and digest it. Don't hesitate to reach out to us. We're here to answer questions and what have you. It's either you can send them to hello@MidAtlantic IRA, or call us. But don't call us in the middle of the night because no one will answer, or at least I won't. But again, we're here to help you. Look for our future programs. We'll take off December, but we'll start up again in January. And I think the first one in January is investing in real estate in your retirement plan. If you have other suggestions or things that you want to hear, send them to us. We're more than happy to include those in in our meetups. We have 2 meetups a month, although this month we combine them. We have 2 meetups a month. One which is clients only, tends to be a little deeper dive. We get into, sometimes it's more of a workshop. A client has this issue or that issue, and they're trying to figure out how to do something. Whereas the non-client, or the general session, if you will, is more generic and topical. Although I do get in, I dig pretty deep, as you guys can tell. So again, I appreciate your time. Hope you have a happy Thanksgiving next week, and we look to hear from you soon. Appreciate your time. Thank you very much. Bye-bye.
Jack, can I ask you one more question?
Yep, sure. Encore.
The January session on investing in real estate, is that going to be clients only?
We have one that's clients only, and we'll have one that's general. So and I forget, Siobhan puts all those together. She's actually at a conference right now, hopefully working, and but she'll put it out, Bob. I don't. I'm not exactly sure what the topic is. I know it's real estate based.
So the reason I'm asking is because I go to a lot of these real estate meetings, these REIs and stuff like that. And
Yep.
One of them up here in West Virginia, we got talking about that. And I keep trying to express to them about the self-directed Roth with real estate owned. And they're interested, but they don't know the details. It's been 15 years since I first met you, and
Yep.
and it's grown exponentially, right? It's worked out really well. And so they were interested either having you talk, or if they could come to the session, right, or to a session, as opposed to them going to a meeting. Then it just makes sense to me. I try to explain to them how their money grows if they don't need the money right away and they put it in that Roth. It just grows, right? It's just
Well,
and the tax advantage is free.
Right. So there's a couple of things that we do with groups. As I speak about this all over the country.
Right.
So, at West Virginia, where in West Virginia is the group?
Charlestown. It's in Charlestown, West Virginia.
Oh, so it's okay. So it's down south. So that's still a couple
not
hours
Charleston.
from me.
Not Charleston. Charlestown.
Oh, Charlestown. So it's Harper's Ferry,
where the racetrack
area.
is. Yeah.
Oh. Well, I don't mind going to the racetrack. That's right. No, that's right around the corner from me. I'm not very far. So I would, depending on size and those sorts of things, I'm more than happy to do it in person. I'm more than happy to come to the group. I speak to, as I speak to a lot of real estate groups all the time. Many of them also have, what I would call strategy sessions or subgroups. And we do a lot of speaking at the subgroup. So it might be in a meetup format. Okay. And those would, we would do that just for that group. Okay.
Okay.
So lots of options.
Okay.
Thanks.
That was the question. Thank you. Thanks for the overtime.
All right. Oh, no problem. So, everybody else on this call is going to bill you. So send your bills to Larry. All right, guys. Appreciate your time. Thank you very much. Take care. Bye-bye.
Thanks.